would you say growth stocks are still a buy right now? I mean, we've got tech and communication services stocks are really what powered the gains today. How do you think about valuations there right now?
Look, I think growth stocks have done spectacularly well since December 26th at the very low, and what we recommended at Bulltick at that point was to go long growth stocks. The S&P is up, 17% since December 26th, fueled by the sectors that were most beaten up by the principal fears that took down the market, which were, the Fed, trade war, and U.S. recession. So at this point, we see more value in other sectors that have to play catch up. For example, defensives. For example, food, beverages, and tobacco stocks that we think present nice value.
Mike, clearly there is some value out there. What about the valuations overall? How are they looking on a sort of historical basis?
It strikes me as neutral. I think we're around the 5-year average for S&P price earnings ratio. If you look at the 30-year average, it's really not what the long-term average is in terms of 15 times earning. It's actually more like the high teens on a trailing basis. So I say neutral, and that's why the big question is just what earnings are going to do. It's not so much how much we're paying for each dollar of forecast earnings. It's whether those forecasts start to stabilize and then maybe pick up again from here. So I think in general, that's not what's been holding the market back. It's much more been about global exposure to various companies that various companies have, and risk appetites. I think today showed you, last week I was saying, it looks like a benign pullback right here. You're not seeing signs of credit stress or anything really haywire in the system. It just seemed like a profit-taking pullback, and it did seem like today's response said that professional investors felt they weren't sufficiently exposed to stocks and took advantage of this little 3% dip. By the way, we're still 1% below that level that has thwarted 4 different rallies in 6 months on the S&P. So it's not as if this was an all-clear signal today.
Mike, in terms of the yield picture, you said that we've got lower yields, so it shouldn't spook investors based on that sort of valuation characteristic, but it's also a slightly bearish move, and it could be forewarning about a pullback.
I think it's bearish if the yield curve compresses from here, or if you see the Treasury market start to go on high alert about another downshift in growth. It's not quite what I'm seeing right now. It really just seems as if everybody's on board with a patient Fed. Global yields are much lower. And right now, anyway, there's not a lot of inflation sensitivity, at least, in that market.
Now, Morgan Stanley out with a bearish note saying evidence is building that a market correction is likely not over until margin pressures stabilize. The note goes on to say that the 2017 U.S. tax cuts likely caused the Fed to tighten more quickly and also cause the economy to overheat. Kathryn, if I come to you, very much linked with the point we just discussed with Mike with the outlook for rates, what's your take on that?
Yeah, look, I think the equity risk premia is enticing, and it's inviting more, as Mike just mentioned, institutional real money back into the equity market that got spooked because of this combination of negative factors that led us to close the fourth quarter with a nearly 20% top to bottom move in the S&P. I would say, look, Morgan Stanley's right in the sense that of course there's going to be some correction. Of course there's going to be volatility. Anything can incite that. We can have bad data out of China again, or the president come out with a negative tweet with regard to trade negotiations. Look, what I'm telling our clients is if you're nervous about a correction and you want to preserve your upside, you can look to buy puts, you can look to raise capital, raise cash on your strong upside positions, you can buy risk. There's ways to protect your portfolio without really getting spooked and selling the majority of risk, which I think would be a big mistake.
Yeah, and Mike, when you talk about something like margin pressure, obviously there's tariffs, some of the other areas where we've seen increased costs, freight, transportation, et cetera. But then when you look back at the jobs report that we got last week, it was a really disappointing number in terms of that headline jobs number. But wages, again, increased. Is that something that needs to be watched more closely right now?
I think so. You're starting to hear a little more chatter about it. I think you look inside that wage number. It was the hourly number. Our average weekly earnings were not up as much because the work week was smaller. So I don't think 1 month's data is going to cause that. But I do think certain sectors are, if you look at the restaurants, and in their conference calls, they've been talking about it already. But if you look at the stocks that were leading the way today, the Facebook, Apple, Amazon, Netflix, that's not really part of the picture for them because they do have the kind of wide and defensible margins for now anyway.